Rudi Filapek-Vandyck from FN Arena. Thanks for joining us today, mate.
My pleasure. Definitely my pleasure.
So we are here to talk about the earnings season that has just completed, but maybe before we get stuck into the specifics, got lots of questions to ask, but before we do that, tell us a little bit about FN Arena and what you do there, because you are the the earnings season specialist. That's why we're talking to you, mate.
Yeah, we've sort of become to known as the earnings season specialist. To my surprise, more people should do it, to be honest, but it's good that people don't do it because that makes us a little bit special in this market. For those who are not familiar, we started more than 2 decades ago. To my surprise at the time, nobody was paying much attention to broker research and unless you were an American firm, of course. We thought, we can do that. So we built a whole business around essentially making the market transparent and showing people who is doing what in terms of brokers, who places a buy on this stock and a sell elsewhere. And we've developed on the back of that, lots of applications, information, consensus targets, consensus forecasts, you name it. Our main product is the Australian Broker Call Report, and that's published every day. And over time, we thought it was very obvious to look at company results, because at the end of the day, as investors, we should realize that that's essentially what we are investing in company profits and earnings and prospects. And again, in a similar vein, we found that not many people were doing a consistent, in-depth analysis and review of company reports. And we nowadays do it whole year round. We do it in February, we do it in August. And most people might actually forget about this, but we do have a few dozen companies that report in between. The likes of Aristocrat Leisure, Zero, Technology One, but also the likes of Instack Pivots, Orica, and a lot of some of the smaller retailers and mining stocks as well. So we nowadays do it whole year round. So because we've been doing this now since 2013, that's more than a decade. So we have a lot of data as well. So anything that happens this month or last month or in February, we can reflect back on the history, and we have some background and a lot of feedback that we can rely upon to place anything that happens in this reporting season in context, essentially, because I'm a true believer that context is as important as the facts. And I see a lot of people constantly pointing out facts, observations, and what's often missing is the context. And then clearly when we started, we were a little bit unsure about the context, but nowadays we have lots of data, so we can place context around things as well.
Well, let's put some context around this reporting season, because it's very difficult for the average investor to get their heads around a reporting season. There's 1 month of a torrent of information that comes out, and even the market, I think, has a hard time absorbing all that information correctly. I think, correct me if I'm wrong, but your monitor, or what you call your FN, I think FN Arena Corporate Monitor, covers about 350 stocks. So effectively a large part, if not the most of the market cap out there. Let's just talk broadly before we sort of dive down into some specifics of the reporting season. Was it a good, bad, or average reporting season in the context of history this year?
I think every reporting season has a context, and the context this time around was that we are very close to all-time highs as the index, but we have a very polarized, bifurcated market where a small group of companies has done all the lifting, and the majority of the companies is basically still waiting and looking in the sky and going like, "Where's that bull market for us, for our shareholders?" Absolutely. And that's against that context, I think the reporting season has been quite disappointing. Uninspiring is another word that might be used, but in general terms, the weaknesses have shown up. It was not so much that companies failed to meet expectations in their financial 24 numbers, or for the 6 months to June 30. That was reasonably okay. But then came the outlook, the signaling, the indications for what is likely ahead in the quarter, maybe 2 quarters ahead. And that's where all the disappointments kicked in, essentially. So on our number crunching, we actually have around 36% of all the companies reporting as a disappointment. And that's for people to understand what that also means is that it means that all the analysts that are covering these stocks, they are basically cutting forecasts. And in a very simplistic sense, usually when a company disappoints, you see that in the share price as well. And we've seen that, but you don't always see that. But as a market in general, and I think that's one of the conclusions that I also drew from August, is that earnings forecasts are down. Share prices in general are up because we're not that far off from an all-time high. That essentially means that the market has, all else being equal, has become more expensive. And it's not that the market was looking very cheap before the season. So it has become, throughout the season, on average, more expensive. And that's why I'm not surprised that we see some weakness kicking in September, even though that might be inspired by the US. But if you really want to be nitpicking about it, you have to question whether the current very high multiples for the market in general, whether that maybe is not a little bit on the too hot under the collar side, given the fact that this reporting season has again proven that the outlook is actually quite subdued. We're not having spectacular growth ahead of us, which we've had in certain years, but not at the moment.
It brings up the point. I think one of the stats that you had in the report that you've got coming out for your members, more than 40% of company reports triggered moves of 5% or more in this earnings season, which I guess historically that seems to me to be a pretty significant number. And it just suggests that there's a lot of uncertainty around this outlook, around how companies are pricing. Because one of the things that's worth pointing out for listeners is that these days companies tend to guide pretty well throughout the year. So by the time you get to reporting season, there's generally not a lot of surprises. But that stat suggests that there is a lot of uncertainty around the place. I don't know whether that's skewed more towards resources and the fact that China is weighing on the resources sector, or whether it spreads across industries like just general industrials and that sort of stuff. I'm just wondering if you want to make a comment on that.
Yeah, well, one of the observations you make is actually correct. See, over the years, as we've done this, we see reporting season itself changing. So it used to be the case that sometimes the market wouldn't hear from companies for 5-6 months, and all of a sudden the result comes out. And
Yep.
and on the ASX rules, companies only have to update if they think that the forecasts are off by at least 15%. Right. So if they think they're going to miss by 7, 8, 9, 10, 11, 12%, they don't have to update the market if they don't want to. And that's where previously you would see sometimes these really big misses coming out, which would clobber the share price and everything. Long story short, what we see increasingly happening these days is that we actually almost have a quarterly reporting season in Australia, because a lot of companies, in particular the retailers and also increasingly the technology companies and the mining stocks, of course, they all give quarterly trading updates. So you sort of get a good feeling what's happening there. Clearly not in terms of costs and investments. They don't have to announce that in quarterly updates, but so you get a little bit of a better feel as an investor what's happening inside of a business. And then when they come out then in August and they have to disappoint, that tells you a lot about the weaknesses and how much control they have over their business and etc. And how much, sometimes how quickly things can deteriorate. I mean, sometimes things look okay up until, let's say, the 30th of May. And then in those final weeks, and then clearly the early weeks of financial 25, all of a sudden the situation has completely changed, which then obviously changes the proposition going forward. What we've seen is that the average of 5% movement of share prices on the day for 40% of companies is quite high. And needless to say, the majority of those moves were to the downside. And that is also historically to be expected, because as I said earlier, the share market is not where it was a year ago. It's a lot higher now. So share prices are a lot higher. And that means the market is much harsher when you come out and you miss, and sometimes you miss by 2%. But then the share price goes down by 4 or 5 because, your share price is high, basically. And if you were starting off from a beaten down level and you missed by 2%, you might get a rally of 10% in the share price because it's not priced in, or it was priced in for worse. And it's good for investors to understand that dynamic, which sometimes makes it difficult to understand for an investor why a falling share price actually can be a blessing. Because it just means too much was priced out, but it gives you the chance to buy more shares, basically. A falling share price is not by definition a bad thing. Although the way we are programmed and the way we look at the share market, of course, we are so determined by the share price action that we often have the conclusion of like, oh, it's a bad company. The bad company might have missed by 2%. And that means it's not a bad company at all. The reason why you owned it, hopefully for at least the next 6 months, year, 2 years, 3 years, that reason might still be intact. The fact that the share price pulls back in August, that gives you the chance.
That raises the question, how short term do you think this market is at the moment? You talked earlier about the bifurcation of the market and how quality stocks are absorbing a lot of the capital, and anything that disappoints is just getting dumped. Maybe I'm interested in understanding a little bit more about the fund manager or the broker's mindsets when this happens, right? They're very focused on wanting to not be in stocks that are disappointing or trending down. It's a very much a momentum game. How much do you think this season is in particularly characterized by this short-term mindset, not wanting to wait, say, 6 or 12 months for things to get a little bit better? They might think the stock price is not going to do anything for a little while, so they're cycling into stocks where momentum is still trending. How much do you think that is influencing movement in prices right now?
Well, that's a very broad. We could probably order a few beers and talk about that for the rest of the day. But let me give you a few examples that immediately come to mind. Whenever I see stats about the average holding period of fund managers, we're not even talking about brokers here, fund managers, that has consistently reduced over the past decade. And I will have to think, I think the latest stats are something around 15 days on average, if I'm correct. That's how short some of those holdings have become for fund managers. I mean, not even talking about hedge funds or, I mean, it used to
sounds like a trading strategy.
Exactly. It used to be years ago that those averages were 5 years, 7 years. Yeah. So clearly that has completely gone out the window. I'm not a fund manager myself. I'm only paying attention from the sidelines. But what I definitely observe is that they are much more short term in many ways, but that's not. I think apart from the fund managers, what I notice, and this is one thing that definitely also my own database and social media has helped me to understand, is that the natural attraction of any investor is to stay with the trend or to go with the trend. That's just, I mean, even if you go outside the share market and whenever house prices are falling, nobody's interested in buying a house. I mean, there's only a few.
The old herd instinct.
There's only a few that actually go buy a house. But when house prices are rising, that's when all of a sudden everyone wants to buy a house. I mean, it's almost the same in the share market. Some of my favorite stocks that I still hold today, they've gone through periods when they didn't move, and then you see people on social media, I've dumped it, it doesn't move. I see other talking heads on television going like, oh, we've dumped it, it doesn't move. I mean, and then 3 years later, it has done 100% or 150%. Yeah. So I think that's where the challenge comes in, irrespectively of whether you're a fund manager or a stockbroker or retail investor. The challenge is to distinguish the share price from the company. And that's not always, I totally admit that's not always easy. And sometimes I even have to sit back and I have to reflect on things. Like for a practical example, stupidly or not, obviously my timing was off. I sold a small cap stock and I bought into Ordinate Group. because it had fallen quite a lot. And I still think that company is a future winner. It's going to be the national standard, the international standard, I should say, in its specific field. But clearly, it's still a relatively small cap stock. It only makes.
Sorry, this is Ordinate.
Ordinate Group, yes. The company code is 88. So, but still, in the bigger scheme of things, it's still a small cap stock. I mean, it makes, I think, from memory, 99 million in revenue annually or whatever. I mean, large cap CEOs spend that on a lunch, right? And these guys, that's the whole years of revenue. But clearly, I bought them in my portfolio, and then they come out in August, and they obviously disappoint, and the share price tanks, and that gives you that moment that you have to think like, oh, have I now completely done the wrong thing or not? And then it also brings again forward the danger with small cap stocks. Small changes can have a big impact, and that's essentially what a company like that sometimes falls victim to. It
wasn't the only small cap that happened to.
No,
across the board.
Absolutely. And that again brings back home that I know that there's always this discussion amongst investors whether you should pay attention to the macro context or not. And there is a narrative out there that some investors say, like, forget all about that, never mention the news, don't think about anything, simply concentrate on the company. And I'm not quite sure about that myself, because I actually think if you do pay attention to the macro context, that's when you also see where risk sometimes is hiding and where it sometimes is more than usual. And again, we saw that in August. If you go through a period where the economic momentum is just slowing, and interest rates, in particular in Australia, they stay high, and the consumer budgets remain under pressure, it sort of makes sense that the cyclicals are gonna get it on the chin. And the other part, of course, is that small cap companies, they feel it much worse than large cap companies. Not across the board, because you have differences in sectors. But in general terms, I mean, if a small cap company loses a contract of $2 million, just for the sake of argument, well, if your revenue is $10 million a year, or $100 million a year, or even $300 million a year, that's a hit. I mean, you're going to feel it in the share market. If your revenue is $2 billion, I mean, not even worth mentioning. And that's essentially what we also saw in August. So, are we crowding around the same companies? Yes. And I do think that's partially because we like to be with the winners as a community. But I also think there's another reason for that as well. And that is that we are post GFC. We are in a relatively low growth environment. I mean, everyone is now highlighting that the economic growth in Australia in the June quarter was the lowest since the early 90s. While that might be true at face value, what they also need to mention is that for every economy out there, that is almost the case. I mean, you can make the same case for the US, for France, for Germany, for Belgium. I mean, even the likes of India and China are not growing as fast as they were 15 years ago. So there is a general context. And I think in that context, we see that the gap between winners and laggards becomes ever larger and larger. And I think that's essentially what you then see in the share market. And you see a lot of traditional, vulnerable, maybe not the highest quality companies. They find it very difficult to basically create ongoing value for shareholders. Like one of the examples that might surprise a lot of investors is that most of the large caps we have in Australia, ranging from BHP, Rio, to Centre Group, to the banks, all the banks with the exception of Commonwealth Bank, they all are sitting on sharp share prices now, which are still below where they were in 2007 and 2008. That's more than a decade ago.
Yep.
And then you have the other alternatives, the Macquaries, the Goodman Groups, the REA Groups, the car groups and everything. If you look at their charts, I mean, it's multiples higher over the past 10, 15 years. That, of course, is the bifurcation we have in this share market. And you will, over time, you will see that apart from the valuation discussion, but in general terms, there was always an inclination to be part of that group of stocks, because at the very least, you can visually see that they're going up. And the other ones, they're not going up. And people always complain when something goes wrong in the share market. It's always due to the machines or to ETFs. Or I have a different view. I look at the share market. It's made up of people. And if you understand people, then you will understand a lot that happens in the share market as well.
When you say people, do you mean the participants?
Yes.
So the investor psychology that's driving prices?
Actually, it's us humans. I mean, I often imagine, and I've sometimes in the past made a few jokes about that. I often imagine myself sitting with a beer somewhere and then having a few aliens around me. And then I try to explain to them what's happening in the market, and they're having such a great time. They're just laughing their socks off. And because sometimes when you look from a distance at the share market, it sometimes makes no sense at all. But because we're in the moment, we all think it's very fascinating. And in particular, I'm a journalist, but I've come to realize that the biggest mistake that we can make is trying to seek reason in every single share price move that happens on a given day, right? And I think some of the intelligent market watchers I sometimes pay attention to, the most intelligent thing they sometimes say is that sometimes it just makes no sense. And you just have to accept that, right? The share market is not 100% intelligence. I mean, it's never been, it never will be. Right? There is a whole basket of different narratives, different philosophies, different strategies, different levels of anything, of everything it comes together. And Dennis Gartman, he always used to say, all the intelligence and all the stupidity, they come together and meet each other in the share market. And you just have to accept that that's the case.
Well, you've set me up pretty well for this next question, which I didn't actually forward on to you beforehand. So I'm not exactly giving you a pre-question here, but I've got a couple of names for you, and I want to give you, and just as I guess to put some context, when I say a PE ratio, you and I both know that PE ratio does not denote value, but it is a shorthand way to sort of think about whether something is, overvalued, undervalued. But I also want to give some earnings per share growth forecasts with that PE number to provide some context. So with what you've just said in mind, I want to give you these numbers. So Commonwealth Bank trades on PE of over 24 times 25 earnings, and it's got, this is consensus numbers, about 3.5% EPS growth for nearly over 24 times. Wesfarmers, nearly 30 times earnings, and its consensus EPS growth is about 10%. Goodman Group, 26.6 times earnings with consensus EPS growth of about 15%. Breville Group, 35.5 times PE with about 12% consensus EPS growth. And rounding out with JB Hi-Fi, 20 times earnings on the PE ratio with about 3.5% EPS growth. So I remember reading One Up on Wall Street, the old Peter Lynch book, and his rough rule of thumb was you could buy a growth stock for 30 times earnings if it had 30% EPS growth. Done, no problems. And that would work for you. What I'm seeing here, this crowding into these names, very good names, very good quality names, no question with that. The question I have, once the narrative goes and once we're sort of left with the bare fundamentals of what these companies have in terms of their earnings growth, not sure how things work out for investors buying it at high levels as a group. Sure, one or two of these companies could work out. I guess I'm talking about if you're crowding into these popular now companies because they're considered high quality, because they're considered, well, when I say good growth, the EPS numbers aren't necessarily suggesting outstanding growth. It almost feels like growth these days is just growth. And if you've got any sort of question marks over growth, you're in the sin bin. But anything with, you're going to grow, you're good enough to grow, massive multiple on it. What do you think about that?
Do I sense a little bit of a frustration of the contrarian value investor there?
Absolutely, but I'm also, I guess, talking purely from what's a rational way to view markets, and this is clearly a narrative-driven market. I mean, CBA is now a consensus call to sell. Like it's not saying anything unusual to say sell CBA.
No.
Nearly everyone's saying that.
Yeah.
But you look at I think it's the highest price bank in the world, I would say.
Yeah, I mean it's not. Yes, it's not the first time. We have to pick this apart a little bit, and because there are really many angles here, and not necessarily the one that you put forward. But let's go with CBA first. Yeah. And this is actually fascinating because I've spent a lot of time in researching the banks in Australia, and because one of the contrarian observations I've made already more than 10 years ago is that whenever you ask anyone, fund manager, stockbroker, investor, which one of the banks should I use or which one of the banks should I buy, they would never say CBA. CBA is too expensive. Right?
Always expensive.
And unfortunately, that was the case when CBA was $60, and it was when it was $100. And it's always the case basically. But here comes the remarkable observation. I've just earlier said most of the large caps of the traditional ones are still in share prices below where they were in 2007. People might be surprised that National Australia Bank was more than $40 in 2007. Right? They've never been even close to that. They're now, from memory, around a little bit in the 30s, I think now. CBA is the only one that post GFC has had a tremendous return, and the share price is many times, many levels higher than where it was in pre-GFC. Also, if you could have bought CBA at any time in that uptrend, and you would have still outperformed the other banks. So there's that disconnect where you think, but I should be buying the cheaper one. But the cheaper one, you're not buying the best performing one. You are buying the highest yielding one. But needless to say, there are some contradictions there. And I think CBA is very symbolic of that. You can also throw in a company like Cochlear, for example, which is sort of the same dynamic. I think what we've seen over the past maybe 1.5, 2 decades is that the valuation of companies has diverged. It has definitely changed. It's no longer simply, this is the profit, this is the multiple, this is the right valuation. And some companies, I don't know exactly for every single company what the exact reason is, but I observe that some companies are consistently on a premium, and they do not lose the premium. I mean, I said earlier at the beginning of this conversation, one of the things we do is we give an oversight to people of what the stockbrokers say about companies. We've gone through multiple periods when there's not one single buy out there for CBA. And they'd be lucky if they have 1 or 2 holds or neutrals. And it usually is underperform, sell, lighten, all the negative ratings you can think of. But then 2 years down the track, you notice it's the best performer again, even it was irrespective of the valuation. So I do understand, and for my own evolution as an investor, I've had to get my head around this as well, because I focus on quality companies, and I try to have a whole basket of quality. Now, some of those quality companies, they will trade at a premium. Yep. And you have to be comfortable that premium remains in place. If it doesn't, yes, you're gonna lose your pants. And there's a few examples in the share market. Examples that comes to mind, for example, is Ramsay Healthcare, for example. Up until, let's call it 2016, maybe around that time, it was still highly regarded. It had a good track record. It had everything going for itself. It had a premium valuation. And that premium has now eroded, completely fallen away. And you see the share price is now basically below 2016, I believe it is. And that's what happens then when a premium stock basically loses its premium. Now, I've seen CBA, I've seen the research, I've seen the recommendations, and the fear often is we can't recommend it because what if it loses its premium? Yeah.
Yep.
But the problem is it never loses its premium. If anything, that premium has only gone up. Now, this is probably over that hill period, it's probably one of the few times where I now agree with people saying, oh, don't buy CBA. In all the other previous periods, I would say disregard it, just buy CBA, ignore all the other banks. Because at the end of the day, it's the premium bank, it's the quality bank, it's the superior bank, it's everything that the other ones are not. And that ultimately is reflected in the premium and in the share price and in a better performance. Why I worry now is that premium that traditionally was always on the share price, that has just blown out now. I haven't done the exact research and measurements because, I mean, we've been doing other things with the reporting season, etc. But I'd be very confident to say that if we would map the premium over the past 2 decades, that the premium that CBA now has compared to the other banks has probably never been as high as it is now. Yeah. And so even if that premium just shrinks, it doesn't have to disappear. It just has to shrink or goes back to trend or whatever. That what might mean big underperformance for CBA shares. So that's how I see that part. The other part with the other companies, some of the other companies you mentioned is, I don't know exactly how or why, but what I do know is that the valuation of companies has really changed over the past 2 decades or so. And the best way is referring to Aswat Damodaran in the US. And he's sort of the dean today of how to value companies. And he has a lot of information available. I've read some of his books. I
think he's got a free website where you can check on a lot of the stuff that he does, right?
And he does. And he also puts some of his courses on the internet and everything. At the end of the day, I'm not so sure whether you need to know all these things and do it yourself. Like, what on my observation, a lot of the analysts that we amalgamate at F1 Arena, they basically doing the work. I mean, and they'll tell you that, an example, REA Group can still be valued higher than where the share price is today. I mean, whether you go along with that or not is by the by. But needless to say, I mean, even a stock like Wisec still has price targets around the current share price. I mean, so it's not as simple as just one of the difficulties I've noticed over the past decade is very much how you view certain companies. Like, I've seen the transformation, for example, of Goodman Group. And that has led that everyone who was used in valuing a typical property stock, already 10 years ago was saying, overvalued, basically the way we are now looking at CBA. And look at what happened to the share price. I mean, for the simple reason that it's not valued as a property stock now. Now it has become 2 things. It has become a growth stock. And it has now tapped into some of the strongest mega trends that we are experiencing in our lifetime. And clearly that commands a different valuation. I mean,
well, you could argue it did that in the previous decade with industrial properties, right? That was when the industrial property sector was getting built out. It was one of the leaders in that. And now it's moved into data centers, and it's a very narrative driven story.
But the difference with back then it was a traditional property developer, which loaded its balance sheet with a lot of debt. And that's what you see when the GFC came along. They basically went out of business. They were narrowly, kept their business going.
As did nearly every property trust player at that time as well.
Yeah. And the good thing is they learned so much from that they will not make that mistake again. And they've become arguably a much better company. And you're right. Of course, there's a narrative, and narratives are what moves the market essentially. I mean, You see it in commodities all the time. I mean, uranium, lithium. As long as the narrative holds on, those share prices will not come down. If you refer back to the GFC, I remember the year 2008. The stocks that held up the longest were the commodity stocks.
Yep.
Until, of course, when China then slumped and everything went down the quagmire. But it was the narrative of the stronger forever, basically, that kept investors in copper stocks at the time and in oil.
This is not quite a narrative that I guess is widespread, but just in talking about these quality stocks and the premiums that exist at the moment, I wonder if it has, do you think it has anything to do with the fact that we are in a higher structurally inflation environment with government spending considerable amounts on the fiscal side? So fiscal has really taken over monetary policy over the past few years. And to what extent do you think capital is moving into these companies? It's almost like as a growth bond type of exposure. So instead of being in a government bond fund where you're going to get a little bit of income, but also you're getting erosion from inflation, you can get your inflation protection by being in a CBA or by being in a Goodman Group, because they're obviously functioning businesses that are in some ways not necessarily insulated from inflation, but certainly more so than a government bond. Do you give that much stock, that theory?
Yes, but probably in a slightly different way. I think with examples like the banks and the CBA in Australia, I think we have to realize that there's money out there that doesn't necessarily is being allocated on the basis of valuation. People make different decisions, and it's like the banks, I think, to a large extent, have been one of the mysteries in Australia. I mean, I can't open a report by a fund manager that either has no allocation or an underweight an allocation to the banks. All the stockbrokers are negative. To my understanding, retail investors have been selling too. And the ones who have been buying in Australia are the super funds. And somehow those who sided with the super funds, they have won out so far. All right. And we should realize sometimes that it's not just about valuations. There's obviously other reasons sometimes to allocate money. To come back to your original question, I think what we are experiencing, there's two things here. And I think they're very, very decisive in the climate in which we are investing today. One is that central banks are more involved in what happens in markets. I mean, in Japan, half of the bonds is owned by their central bank. In Europe, every large European listed company is owned by the Swiss National Bank, and so forth and so forth. Is the Federal Reserve manipulating the U.S. Treasury market? Absolutely. I mean, and they've become better at it. So one of the reasons why we haven't seen large sell-offs, and if we have seen them, they've been really short-lived so far. That's central bankers basically getting better at managing markets. I also think, for example, we had in early August, we had a little bit of a breakout that happened in Japan. I can visualize how the telephone between the ECB, the Federal Reserve, and the BOJ was being picked up. People talked, and within days, the share market was back to where it was. That's comforting for investors to a certain extent. The same probably goes for the inflation and the economic growth picture as well. They've been better managed, so we don't get 9% growth in 1 year and -7 the next, which is what we had in the 60s and the 70s, for example, 80s to a certain extent. The other thing is that we are living in a time of abundance. And when I say abundance, I say there's so much capital these days. And it's not just the Fed printing money, but it's the Chinese are doing it, the Japanese are doing it. There's so much abundance, and just as a little bit of a sidestep, one of the reasons why cryptocurrencies all of a sudden are on everyone's radar, and they're no longer measured in dollars, but now in thousands of dollars. And we have all these narratives there that they are an asset diversifier and they are a protection against inflation, all of that. There's a very big chance that the simple reason why they exist and why they have become popular and why they have been carried so far is the abundance of money.
They're just absorbing some of it.
Exactly. And money has to go somewhere. And you see that every time that the Federal Reserve and other central banks, when they allow liquidity to draw back, you see big pullbacks in crypto. All right. So they are just as much related to abundance as the Nasdaq is, as technology is, and as other assets are as well. So I think in the background, I think we have central bankers that are managing risk much better and calamities. And on the other end, we have an abundance of capital that has to find a way somewhere. And it also goes into housing. I mean, I come from Europe, where housing for a very long time was by no means, as obsessive, as it is in Australia. And now house prices over there, rent prices, everything is just gone up and creates a certain.
Aren't the Dutch outliers though? The Dutch has been through a few housing booms and busts too, haven't they?
Well, the Dutch are a very, very strange country because they always had that we have to keep it. We have to keep it almost like in a communist way. Like everyone has to have a house. So. But the prices now have gone up a lot, and that's a similar dynamic as we now see as in Australia, and that to a certain extent is also the abundance of money. I mean, it has to go somewhere. People, in particular, you could add when there's nothing to be gained from keeping it under your mattress or putting it in the bank. So and I think to a certain extent that also characterizes markets as well.
I was going to say one place it's not going is commodities. Let's talk a little bit about the commodity sector because it is a big part of the Aussie market. Gone through some pretty tough times. You could say it's in an extended bear market. Obviously, China's weighing on that. What's the view of the commodity sector over the next, say, 6 to 12 months?
Well, my worry is a little bit like anyway. Anything I say comes from a non-traditional commodity investor, as I am. The only commodity I invest regularly in is gold,
which is absorbing a lot of that abundance.
And gold, you can discuss whether it actually is a commodity. I mean, some people say it's a currency, it's an insurance policy. I mean, in a very simplistic form, I run a portfolio, and I definitely look at it as a portfolio. So I manage a portfolio. And one of the principles on which I manage a portfolio is I believe there should always be a percentage in gold. And when people ask me, like, how much should we put in gold? My view is always, well, how comfortable or not comfortable are you with the world? And that determines the percentage of gold. Like, very, very simplistically, in 2020, when COVID hit, I quickly had 13% in gold. Nowadays, I probably have like 5%, I think, each, 5% each. And I don't do gold miners, because then I'm in companies and have different type of risk. I simply have gold. And the simplistic form is, can I have some bullion on my bed? I can, but I just buy an ETF. I mean, keep it very simple. Now, that's that part. The other part is that, I found it, I do realize, because I read a lot of research, and people say you should have some commodities in your portfolio as a protection against inflation or the unexpected thing that comes along, war, whatever. I always go, yeah, well, I could see the philosophy, but my worry always has been with interest rates as high as they are. And yes, we are finally going to get some cuts. We are seeing cuts. Mexico, Brazil, England, Canada, US will follow at some point. Europe is already there. But the effects of that come with a delay. And my worry at this point in time is that we will see first more bad news, and then the recovery comes later. So the problem with commodities then is that share prices probably will have to go lower at some point. And does that matter? Well, it does. It matters only if you can stomach the falls. And that's where it turns out about what kind of investor are you? I mean, are you the type of investor that can buy something at $1? You see it going to $0.50 and you still think like, I'm not worried because I know this is going to go to $3 at some point. Yeah. And that's, I mean, there's a difficulty. Can you time it? I'm not so sure because, I mean, I too, just like everyone else, I too read the books that tell you that you should invest according to the cycle and all of that. If it was that easy, I mean, we will all be doing it and we will all make lots of money. And clearly, it's not that easy. In the description I gave earlier about how financial markets operate these days, on my observation also it is that the whole concept about cycles is pretty much gone out the window. You know what I mean? Cycles have been very short or very shallow so far. And on the assumption that we won't see a recession, which still is not 100% excluded, we can. And in that case, I mean, I don't think you want to hold resources. I mean, that's just bad news. But on the assumption that we don't see a recession coming, then all else being equal, it can again be argued that the cycle has been very, very long this time and very, very shallow. I mean, it's very difficult to pinpoint when exactly this economic cycle made a turn because obviously we had COVID interruption, all of that. But needless to say, I'm the type of guy I can miss out on other people doubling or tripling their money, knowing that they took on a lot more risk than I did, and I can sit on my stocks, and I'm never jealous when someone doubles their money in some small cap mining stock. That's fine. I mean, you took the risk and you get the reward. But
well, it comes down to knowing what type of investor you are, right?
Yes.
Being content with
yes,
that.
Exactly. But I'm also always surprised how people are surprised when things go wrong and they're sitting on a whole portfolio full with small cap energy and mining stocks. And I always think like, well, what do you expect? They don't just go up, you know what I mean? And they're very sensitive to economic signals and to price differentials. I mean, I understand the attraction. I mean, you buy them at 2 cents and they go to 20 cents and that's a lot of money. Yeah.
They can also go to zero.
But they can also go to zero, exactly. And people have this idea like it goes to 1 cent, surely it can't go lower. Yes, it can, because you have to look at the share market. Some share prices are point something, so that's less than 1 cent.
Yep. We've been going for nearly an hour now, so I'm going to finish off with a question that relates, I guess, back to a lot of what you do on a daily basis, which is take in a lot of information from a lot of different sources and try and condense it. I just wanted to get your take on how you think about consensus opinion and how you then interpret that to try to get not necessarily an edge or alpha, but try to how to add value to your client base. Because if you've read your investment books, you know that consensus is generally wrong. It can be right in the short term, but it's whenever consensus is priced in, there's nothing left for the investor. How do you think about that, dealing with consensus opinion on a daily basis and trying to think about where that might be right, where that might be wrong?
Yeah, well, I do think it's not that black and white. I do think, just like so many other things in finance, a context for everything. I actually think that consensus is often right. And that's why, like, sometimes people try to be contrarian just to be contrarian. And, I read a lot of research, and I read a lot of research, in particular also being done by the American funds, the likes of Morgan Stanley, Citi, Bank of America. I mean, I know they might sometimes be vilified in the public domain, but, I mean, some of those 200, 350 page reports I sometimes have on my desk, I am sometimes absolutely salivating and just getting stuck in there. There's a lot of information that you can absorb and that you can only become a better investor from. And I do remember vividly 1 or 2 reports, by Citi where the conclusion was, this is not the time to be contrarian. All right. And you learn from that. Consensus is not always wrong. When it comes to making forecasts, I do think we have to realize that essentially everything we do in life is based on forecasts. And it's also just like anything else in investing, it's a numbers game. If you talk to fund managers and you ask them in a very open way, let's give me the truth, don't give me the spiel. How many calls do you make right? How many calls are wrong? On average, if they're a good fund manager, they have 6 out of 10. I mean, that narrowly beats the coin 50%. And that's a good fund manager. If they have a year when they have 7 calls out of 10 right, they get worried because they know it's probably going to turn the next year. Yes.
Yeah.
So that gives you an idea. And I think I've done the numbers for the stockbrokers on my observation, it's about 6 out of 10 as well. So it all comes down then where do you put your emphasis? Are you going along with the 6 or are you going to complain about the 4? And I think it's about how you treat it. I mean, the way I do it, see, where I'm sometimes a little bit different than other people as well. See, as F in Arena, sometimes we have, let's take a certain stock and you have done 6 or 7, 8 views and there's like 4 positive, 2 neutral and 2 negative. Some investors go like, I don't know what to do now. Like there's no unison in view. See, I personally like that because I like to take guidance from the positive ones, but then I go like, why are these 2 negative? And by looking into that and confronting that with the other views, I sometimes get a much better insight in what the risks are. And sometimes, for example, I can see from the negative views that those positive views are a little bit built on not so strong fundamentals.
Well, it allows you to build probabilities, right?
Yes. And also get better insights, give a different view, knowing the risks and all of that. So I think that's how you should use the information as well, right? And I think that's where you become a better investor. When it comes to broker reports, I think too many people are focused on the buy, hold, sell. Yeah? I usually don't even look at that. I look at what's the work that's in the report. How much data crunching have they done? How much work have they done? I mean, and the reasoning behind it. I mean, the reasoning. Why do they think, for example, that there's many years of growth ahead of WiseTech, for example, or of Goodman Group? Why, for example, would you still be cautious about IFL? I mean, Insignia Financial. Why would you still be cautious today? Why are brokers even with the share price below $1? Why is Platinum still not a screaming buy? Yeah? Those are the things that I'm more interested in than someone saying, "Oh, the share price looks cheap. Let's give it a pass."
Must be a buy.
Yeah, exactly. All right. In essence, it's about context and about intelligent usage of the data and the information that's available.
Final question for you. We spoke at the very start, the ASX 200 at all-time highs, yet the reporting season was pretty ordinary, and the result of that was downgrades to FY25 earnings forecasts. What's your view of FY25? Do you think the market continues to sort of grind higher from here, or do you think it's going to have a bit of a breather and a bit of a further correction?
I think we're going to have 2 phases. In phase 1, I think the ones that have performed will continue to perform, which shows you that it can't be to the same extent as what we have seen, because they've gone up a lot. But I do think, for example, that the likes of let's call them WiseTech or Goodman Group, REA, Car Group, Technology One, Aristocrat Leisure, those companies, I think in 12 months' time they should be higher than where they are today. Actually, I think they will be higher in 6 months' time. In 12 months' time, maybe not, because that depends on whether we, by then, have seen a true revival of the laggards, the cyclicals, and you might actually see a little bit.
Whether any narratives.
And you might actually see a rotation by then, like what we saw in the second half of 2016. And then those stocks can actually go temporarily out of favor. And that might then lead 10, 20% down. The experience from 2016, though, shows you then if you take that on the chin and you give it another year, and then you're back on profits. And that's how this market will constantly rotate. But I think at the moment, I would not go by definition contrarian and put my money in the ones that have disappointed in August or disappointed so far, because I think the economic conditions, everything, context, there's probably more challenges, tougher period ahead. And I think the winners are more likely to keep on winning here.
Fair assessment. Thanks very much for your insights. I really enjoyed the chat. For those who want to follow you for a little elsewhere, where can they find you, mate?
Well, they can find me on X, previously known as Twitter, but they can also find me on www.fnarena.com. That's F from Freddy and N from Nelly. Don't do the AU. It's just .com.
It's just behind you there, mate. I think people will be able to.
Oh, there you go.
Check it out.
And
all right. Really appreciate your time, and thanks for joining us.
And thanks for asking me.
No worries.